Most of the information that's come out and shows we're probably bumping along the bottom. Whether we bottomed out or not, for sure, no one knows, but we've been bottoming out for the last 6 months or so, but just bumping up. We have not seen any really major rise in the health of the housing industry. There's still a huge shadow amount of foreclosures waiting out there to add to supply.
Before we go on, I want to show this next slide because this comes from Bill Foster, who just amazing. But let's go to the net worth of U.S. households. It's that slide that we're going to go to, where from October 7th to March, let's go back, go back one. From March 7th through of 2007 to March of 2009, we lost $17.5 trillion in the net worth of U.S. households and have only recovered $5 trillion since the stimulus package was signed a year and a half ago. Are we coming back for real, or is it? How far is it going to go? And again, what does this do to investments?
Part of that loss is due to investments, but if you consider an investment asset class, real estate, that's where the majority of the individual net worth was in real estate. So it's going to be several years, even in an economy like the Seattle area that wasn't hit as hard as some of the country. It will be several years before the equity comes back and the household net worth will still be behind what it has been.
The proposal that was being talked about that was the genesis of these two slides, actually let's go to this next one because it says worse than the Great Depression, was that if there were to be a requirement of more of a down payment on, for mortgage loans, no more of the no down payment loans, that we would be a lot better off. But this says that the drop in household net worth was worse than the Great Depression. Now, historically, was our net worth tied up in real estate back, during the late 20s and early 30s in the same way that it is today?
No, I don't. I think a much greater percentage of individual assets are tied up in real estate, especially the primary residence. And the problem is, even when people made money in a home that they held, they previously would maintain that asset and then eventually down the road in retirement maybe sell it. But what people were doing is being too aggressive and then moving up in the house value, and then in the process of moving up, banks would not have the same loan-to-value ratios and be more likely to lend higher percentages of the value of the real estate with a smaller down payment.
Well, should I go and invest money right now into some kind of investment pool that goes and buys mortgages?
Not necessarily mortgages, but real estate investment trusts that have cash on the sideline that can take advantage of some of the downturn in the market, especially on the commercial properties. There's opportunity there. So it's not all bad opportunity in real estate. Depends on the investment opportunity and whether or not the assets were purchased prior to the downturn in the market or whether or not the cash is being put in.
So I walk into your office and I say, okay, should I invest in this real estate investment trust or some other thing? What do you do to prepare yourselves to advise me?
What we do is we research. We research through reading pretty much everything we can get our hands on that's legitimate, looking at all the numbers that come out through the government and through private areas as well. And like, for example, fairly easy. Right now, 1 out of every 2 or 3 people we talk to comes in and says, I've got this rental house, I really wanted to sell it, but I'm going to wait for the market to come back. And I'm going to rent it in the meantime. Everyone probably knows these people. Well, the problem is, how do you define the market coming back? Do you define it coming back to the top that was obviously part of the bubble and unrealistic? Or do you define it to a fair price, getting your money back? And then the most important thing is, what opportunity costs are you missing by hanging on to this investment, whether it be a stock or a house?
As far as your question on the real estate investment trust, the way we work with clients is that you should be diversified. So even though there might be some good opportunities for income-producing investments in the real estate investment trust, you typically wouldn't hold more than 5% of your portfolio in that, because just like anything else, even though there's an opportunity, you want to be over-leveraged in any one investment. Now,
for our audience out there, if indeed you have questions, go to this website. It's AmeripriseAdvisors.com. Search on Daniel's name, Daniel X, or just go to AmeripriseAdvisors.com and then search Daniel's name, and then you're going to come up with the website for both Daniel and Eric, because they work as a team, right?
Correct.
Okay, now, ask your financial advisor about healthcare reform in terms of investments and what it means to you. specifically, healthcare reform, high-income individuals face new Medicare-related taxes in 2013. What does that mean?
The main impact of these taxes are going to come on a couple earning $250,000 or more, or an individual earning $200,000. There's a 3.8 tax that's going to come, but not on all income, only on unearned income.
Well, I mean, if I'm a high-income individual, a lot of times those people have unearned income.
That's correct. That's exactly where it's targeted. So therefore, in 2013, the high-income individual could, on not all his earnings, but on his passive income, is going to be paying 3.8% more. The top tax rate is sunsetting. It's 35. It's going to 39.6. Dividends is going to 39.6 from 15%, and capital gains is going to 20%.
So this is a part, essentially, of paying for the healthcare reform.
No, it's paying for. This is paying for healthcare reform. The other taxes are paying for the large deficits that we've built up over the last 10 years.
And the other impact on the healthcare reform is for business owners. A lot of business owners, small and medium-sized business owners, tend to have a lot of their net worth tied up in their business. That essentially, for a lot of business owners, is their retirement plan is to sell the business someday. And the impact is where a lot of business owners are kind of breaking even at this point. In 2014, what the impact is for any businesses that exceed 50 employees, they have to offer health care. Otherwise, there's a $2,000 penalty per employee for 30 or more employees. So above 30 employees, there'll be a $2,000 penalty if you don't offer health care.
If you don't offer health care. So realistically, because health care costs so much, $2,000 an employee, it'd be cheaper to pay the penalty, wouldn't it?
In some cases, that might be the case. The penalty might be cheaper, yes.
Something else about health care in terms of people asking advisors is health care reform consideration for seniors. And we're going to take a very short break, but think about that as to the impact on seniors, not on care, but on the financial side of things. Just want to remind everyone that we're very fortunate to have Dan and Eric Johnson, who are advisors with Ameriprise. They have a global knowledge, and we're talking with them about all sorts of things tonight that are in the news that is affecting potential investments, whether it's yours or whether it's your friends, or just general knowledge that you'd like to have. Strongly encourage you to go to their website. Let's see, it's go to AmeriPriseAdvisors.com/Daniel Exum, and you will find it. Also encourage you to go to this website. Go to YouTube, Public Exposure Scan, and you're going to get to see this show again right up there very, very soon.